Welcome to Woods of Stardon. This is CH. I will be covering the JPMorgan Global Corporate Bond Fund in this video, which is part of my Absolutely Biased Comments or ABCs series. The aim of this series is to cover one fund per video to share how an individual investor can try to find out more about a fund from public sources and do some basic research or simple due diligence on the fund before deciding to buy the fund or walk away. Some quick disclaimers before we start. This is not a product sales pitch or a recommendation to buy. I'm not sponsored by anyone to do this video. Please do your own research and be clear about the product features and risks before taking any action. This video is done as a follow-up request from a viewer's comment in my previous video covering the Amundi Index MSCI Emerging Markets Fund. If you would like me to cover any funds or ETFs, do drop me a comment in any of my videos, and I'll be happy to work on it as long as I can find enough information on the product. JPMorgan Chase is a leading global financial services firm with over 225 years of history and currently managing over $3.9 trillion of assets across a wide range of businesses. Chase is primarily a US-focused consumer and commercial banking brand, while JPMorgan is for global banking and financial services. JPMorgan Asset Management, as the name implies, is the asset management business for JPMorgan globally. JPMorgan Asset Management manages over $3 trillion of AUM across equities, fixed income, multi-asset, alternatives, and liquidity solutions through more than 1,300 investment professionals. These are slightly outdated statistics on their website, so I imagine these numbers would be all bigger by now. The JPMorgan Global Corporate Bond Fund is a sub-fund under the JPMorgan Funds fund family. JPMorgan Funds is set up as a Luxembourg SICAV structure and is UCITS compliant. The fund is registered as a MAS recognized scheme, which means it is suitable for retail investors. The JPMorgan Global Corporate Bond Fund has a large 5-person co-manager team, and as per the information provided in the fund webpage, they all have at least 19 years of industry experience. It is rather uncommon to see this kind of setup, as most funds will have either one key manager or at most just 2 to 3 senior managers running a solution. The Singapore version of the fund webpage provides link to only 3 of the co-managers' bios. Lisa is the head of Global Investment Grade Corporate Credit Team in the Global Fixed Income, Currency and Commodities or GFICC group. Besides this fund, she also co-manages several other credit and corporate bond solutions. Lisa is actually retiring very soon though, so she will be stepping down from the responsibilities of this fund in March. The bios of Andreas can be found in other JPMorgan country websites via Googling. Andreas is the head of global credit in GFICC Group. He is also co-managing several multi-sector bond solutions. Lorenzo is a member of the investment grade corporate credit team within the GFICC Group. Asman is a member of the European investment grade corporate credit team within the GFICC Group and specializes in European corporate credit. I strangely can't find a bio page for Vikas, although his bio is available in a separate GFICC document, and his LinkedIn states that he is currently the head of US credit within the Global Investment Grade Corporate Credit Team. Morningstar shows that there were some manager movements over the years, but the team has been generally stable. Besides Vikas that was added only in 2025, the rest have been co-managing the fund together since at least 2015. From the bios of the managers, we can also gather that this fund likely will focus on US and Europe investment-grade corporate credits. Let's take a look at the fund strategy next. The JPMorgan Global Corporate Bond Fund has a pretty straightforward investment objective. As the fund name implies, this is a global corporate bond solution, and it invests primarily in investment-grade credits. There is a mention of using derivatives where appropriate, but we will see if there are any detailed disclosures provided. The investment objective also starts by stating it aims to achieve a return in excess of global corporate bond markets, which implies the fund will have a defined benchmark to represent the market, and the fund has the objective to outperform the benchmark. JPMorgan, as usual, provides some details on the fund investment process in the prospectus, but I feel it can be elaborated further. Here, it states the fund uses a global integrated research-driven investment process, which basically means that research information from all the different investment teams located across the world are shared. The fund does use multiple approaches including fundamental, quantitative and technical analysis across countries, sectors, and issuers in their research process. It is also stated that the fund focuses on generating returns primarily through credit sector rotation and security selection. The fund has a defined benchmark that is the Bloomberg Global Aggregate Corporate Index. It is stated that the benchmark is used as a basis for portfolio construction, so the fund's portfolio composition and risk characteristics will have similarities with the benchmark. As the fund uses the benchmark for performance comparison, and as stated in the objective, aims to outperform the benchmark, the fund must do something different compared to the benchmark in order to generate alpha, so it cannot afford to be overly similar to the benchmark. The base currency of the fund is US dollars. While this is the norm for global bond fund solutions, it also implies that the fund portfolio will likely have a bias for US dollar issues so that there wouldn't be too much FX management required. There is also a long section in the prospectus covering the specific investment constraints. It is stated that the fund will need to invest at least 67% in investment-grade corporate bonds, though I think it would be normal for the fund to have at least 80% of such exposures at all times. It is mentioned here that the geographical coverage of the fund includes emerging markets as well, which is the same as the benchmark. Other specific investment constraints include max 5% government bonds, max 20% high-yield bonds, max 10% COCO bonds, and max 5% MBS or ABS. I'm skipping all the ESG stuff because they are usually quite generic and hardly impact the majority of the fund portfolio. Money market and cash instruments are supposed to be used to handle fund orders and liquidity only, so it is expected for the fund to stay fully invested even if there is a significant market volatility or correction. Details on derivative usage specific to the fund is unfortunately, but expectedly not available. There is a mention of expected 75% leverage from derivatives, but again, this is not too useful if the fund doesn't provide the details in the actual portfolio for us to understand better. Let's go through the actual portfolio next. The JPMorgan Global Corporate Bond Fund was launched in 2009, giving it well over 15 years of track record. Fund AUM is at a decently large $6.7 billion currently. The reason I find this is a large size is because most investors will go for diversified bond fund solutions instead of focusing on just corporate bonds exposures. So it is interesting the fund has garnered so much investor monies over the years. Since the fund takes reference from the benchmark, I will be comparing the fund's portfolio with the iShares Global Corporate Bond UCITS ETF that tracks the same benchmark index. Let's look at the geographic exposure first. The index as represented by the ETF is mainly exposed to US and Europe, with only very small allocations in Japan and others, including emerging markets. The fund shows similar exposures with small variations on country level. US exposure is notably larger by about 8%. Possibly it is easier to find attractive US dollar bonds in US itself. The fund webpage interestingly provides benchmark information only for sector breakdown, so we don't need to compare against the ETF here. While not significant, it can be seen that the fund has opted to underweight on consumer sectors and in exchange overweight on financials, utilities, and energy. It is good to see the fund taking active decisions to try differentiate itself from the benchmark, although we will see later if this successfully translates to alpha returns. On credit quality breakdown, we can see some clear differences here. The index as represented by the ETF has about 45% single A rated and 45% triple B rated, with nearly no high-yield exposures. The fund, on the other hand, has about 10% in high-yield bonds because its investment mandate allows for it, and also the fund allocates more into BBB rated bonds than higher rated ones. The main objective here is that lower rated bonds generally provide higher coupons or higher yields, so the fund is taking on additional credit risk in exchange for higher potential returns. On a separate note, it is interesting to see the fund has maintained nearly the same average duration and average maturity compared to the index. This either suggests that the fund doesn't really take active duration or maturity views by hedging them higher or lower than the market, or that the current view happens to be neutral. Top 10 holdings is provided by the fund, although this isn't really useful for bond funds that have a long list of holdings in their portfolios. Morningstar shows the fund has over 800 positions, which sounds decently diversified yet still actively managed. The iShares Global Corporate Bond UCITS ETF, in contrast, has over 14,000 holdings. Morningstar also shows small amounts of short positions, although without further details, we won't really know what kind of derivatives this might be. On that point, the fund expectedly did not provide any details on actual derivatives in the portfolio, as with most funds. The JPMorgan Global Corporate Bond Fund has a long list of currency classes, suggesting it is widely offered globally. The fund, however, has only 3 retail A share classes registered for the Singapore retail market, and in this case, it is actually important for investors to take note of the differences. One of them is the monthly distributing US dollar class to cover investors trading in US dollars. The other two are Sing dollar share classes, but are very different. One is a Sing dollar hedged share class in accumulation only. The other is a Sing dollar unhedged share class with monthly distribution. The currency hedged versus unhedged classes lead to very different performance results that we will go through later. But this means that Sing dollar investors will have to think carefully which share class to go for in terms of performance versus distribution option. The retail A classes have a 0.8% management fee. Adding other expenses gives a total expense ratio or TER of 1%. Up to 73% of the management fee can be paid by JPMorgan to distributors as trailer fees. Distributors are allowed to charge up to 3% subscription fee for this fund, although I think anything more than 1% for bond funds with low return expectations is excessive. Some distributors may offer the C classes that are normally meant for Europe, or the institutional I classes. These share classes have no subscription fees as well as a much lower TER than the A class. Investors interested in this fund should try to access these share classes if available. The C Sing dollar hedge class, for example, has only about half the TER compared to the A class. Distribution data of the JPMorgan Global Corporate Bond Fund should be consolidated together with other funds in a separate dividend information PDF document, but strangely, it's not found in this document or anywhere else in the JPMorgan Singapore website. This is the second JPMorgan fund I've covered this year that has this problem, so JPMorgan should get this fixed quickly. Fortunately, Morningstar has the distribution data, and we can calculate the 12-month yield of the fund is currently around 4.5% to 4.7%. This is a slightly lower payout yield compared to some of the other popular global diversified bond funds in the market that are still maintaining a payout yield of around 6% or higher. While payout yield is part of a fund's total return, and there is nothing wrong for a fund to have a lower payout yield but higher capital growth, having a relatively lower payout yield is visually less appealing to some retail investors from a marketing angle. We can also see from the data that the fund has a smoothened payout policy on the distribution amount, which is reviewed and adjusted quarterly. This is a common approach for retail share classes of bond funds. For the US dollar class, from the total return versus NAV growth chart here, we can also see that there has been a slight difference in the prioritization in the fund before and after the COVID period. Prior to that, the fund's NAV had been maintained in a slightly declining range. suggesting the fund prioritized distribution payout at the expense of NAV. The COVID period was an abnormal time for the bond markets. Post-2022, the NAV range is showing a slight incline, suggesting that the fund seems to want to slowly grow the NAV and therefore it is not giving a payout yield as high as possible. For the Sing Dollar unhedged class, the lines in the charts look more erratic, as there are significant impacts from FX movements leading to a rather different chart compared to the US dollar class. Therefore, it seems that in this case the main objective is to provide a similar distribution payout yield as the US dollar class, while leaving the NAV to sway according to FX movements. Investors should therefore be more cautious when considering the Sing Dollar unhedged class. The JPMorgan Global Corporate Bond Fund webpage provides a dynamic performance chart based on monthly data points, as well as performance data table for various time periods. From both data sources, the fund seems to be consistently underperforming the benchmark slightly, which is not good as the fund is supposed to deliver alpha returns. However, the benchmark is not investable, so it makes more sense to compare against an ETF. In this case, we use the iShares Global Corporate Bond UCITS ETF again. As shown in the Morningstar chart since inception of the ETF, the fund has actually outperformed the ETF pretty decently, and it seems to be largely attributed to a notable performance difference in early 2015. Zooming in to past 5 years, the fund has still managed to outperform the ETF slightly. We can also see some periods where the fund managed to reduce drawdowns better than the ETF, showing active risk management at work in the fund. Zooming in closer to past 1 year, the fund has however underperformed the ETF quite significantly. Given there are many moving parts in the portfolio, it is difficult for investors to understand what exactly went wrong, unless the fund provides an elaborate commentary. Regardless, no active fund manager can consistently outperform the market, and investors should be prepared that the fund can underperform like what it is shown in this chart. There are not that many corporate bond-focused funds available in the market. Here are the more popular ones comparing against the JPMorgan fund. In this 5-year chart, it can be seen that the funds are highly correlated to each other, and the JPMorgan fund has managed to outperform the rest very slightly. The more important question investors should ask is whether there is a need to go for a corporate bond-focused solution. For investors with a large investment pool and need to spread the monies across many products, it may make sense to do so. However, for most retail investors, going for a more diversified bond solution, such as the popular PIMCO GIS Income Fund, or the JPMorgan Global Bond Opportunities Fund that are covered in a previous video, have provided better risk-adjusted returns over time. Last but not least, I want to cover the problem of the Sing Dollar share classes. As mentioned earlier, the fund currently has an accumulation Sing Dollar hedged class and a monthly distributing Sing Dollar unhedged class. Here is the Morningstar chart comparing the 3 share classes since inception of the Sing Dollar hedged class that has the shortest track record. Given the current interest rate differentials between US and Singapore, the Sing Dollar hedge class is correlated but lags behind the US dollar class by around 2 to 3% per annum, which is the currency hedging cost that is similar across all mutual funds. The Sing Dollar unhedged class, on the other hand, is dependent on the FX movement of the US dollar to Sing Dollar pair, and in this time period has resulted in a worse performance than the Sing Dollar hedge class. The performance differences are even more obvious when looking at this 1-year chart. As FX movements can distort a fund's performance significantly, I generally would avoid currency unhedged share classes unless I have no choice. In this case, going for the Sing Dollar hedge class means investors would have to accept the accumulation option as well. But this is a small issue, as investors can still make partial redemptions as and when needed to simulate distribution payouts. Of course, the most ideal scenario would be that JPMorgan decides to create a Sing Dollar hedge class with distribution for investors who need the option. With that, let's summarize our findings. The JPMorgan Global Corporate Bond Fund is a product from JPMorgan AM, a global leading asset manager that is under the large JPMorgan Chase business. The 5-manager team of the fund are well experienced in the industry and have senior roles in the firm. While Lisa is retiring soon, the team looks stable and her departure should have minimal impact to the fund. While this is a straightforward investment strategy of global corporate bond solution, the investment process details are rather lacking, making it difficult for investors to understand how the fund works. The fund doesn't seem to be actively marketed by JPMorgan, as there doesn't seem to be marketing brochures and featured fund web pages that would help to better explain the fund to investors. While the fund portfolio is constructed with reference to the benchmark, there are some clear differentiations showing active management at work. Distribution data seems to be missing in the JPMorgan website, so the team should get this fixed quickly. The fund currently offers Sing Dollar hedge class in accumulation only, and Sing Dollar unhedged class with distributions only. It would be ideal if a Sing Dollar hedge distributing class can be created for investors. The fund seems to have consistently underperformed its benchmark slightly across all time periods, which is not good. However, when compared against ETF representing the benchmark, the fund exhibited outperformance on a long-term basis. The fund also showed similar performance with most peers in the market that are all highly correlated with each other. The biggest question would be the positioning of the fund in an investor's portfolio, as global diversified bond funds generally can provide broader market coverage and with better risk-adjusted returns. In conclusion, aside from the small issues mentioned, I think this is a decent but not great global corporate bond fund, considering there are not that many similar products in the market. The main question again for investors is whether there is a need to have a corporate bond-only solution in the investment portfolio, and this would depend on individual investors' needs and preferences. This concludes my absolutely biased comments on the JPMorgan Global Corporate Bond Fund, and I hope it will help in your investment journey. May we all grow wiser and prosper.